All right, so today we're cracking open The Intelligent Investor by Benjamin Graham.
Oh, yeah.
And this is kind of a legendary book in the investing
Right.
world.
It's a classic.
And we're going to go on a deep dive today into his wisdom.
Yeah.
And we're not just going to like summarize it. We're
Mhm.
going to pull out those golden nuggets of insight
Yeah.
to help you, the listener, really grasp how to think like an intelligent investor.
That's the goal.
Yeah.
So what's so fascinating about this book is that it's still relevant today.
Yeah.
Even though it was published way back in 1949,
Mhm.
Graham's principles, they've guided investors through decades of market shifts. And that's why I think this deep dive is so valuable.
Exactly. It's like having a roadmap to navigate the world of investing.
Yeah.
And I think, for anyone listening who's ever felt overwhelmed by market swings
Right.
or unsure about where to even begin, this one's for you.
Totally.
So one of the first things that Graham does is he lays out this distinction between two types of investors, defensive and enterprising. Can you unpack that for us?
Absolutely. So think of defensive investors as people who really prioritize safety and simplicity.
Okay.
They're not looking to spend hours poring over financial statements.
Right.
They want those reliable returns without that constant stress of market fluctuations.
So a lot of our listeners are probably in that boat, right?
Yeah,
People with busy lives, want to invest wisely,
Mm-hmm.
but don't necessarily have the time to be constantly,
Right.
checking the market.
Exactly. And then on the other hand, you have the enterprising investor.
Okay.
And these are the folks that are willing to really roll up their sleeves,
Yeah.
do the research, and potentially take on more risk
Okay.
for the possibility of higher returns. So they're actively seeking out those hidden gems in the market.
So it's kind of like choosing your adventure level in investing.
Exactly.
So knowing yourself,
Yeah.
your time commitment, your risk appetite, that's a key takeaway right from the start.
Yeah, you got to know yourself.
Yeah. So Graham introduces this concept of Mr. Market,
Yes.
and it's one of those ideas that really sticks with you.
It's brilliant.
Yeah. Can you refresh our memory on that?
So picture this Mr. Market shows up at your door every single day, eager to either buy or sell stocks.
Okay.
Some days he's euphoric, offering sky-high prices,
Okay.
and other days he's gloomy, practically begging you to take shares off his hands.
Right.
But the catch is he's entirely driven by emotions, not logic.
So it's like dealing with the stock market with a serious case of mood swings.
Precisely, and that's where the intelligent investor comes in.
Okay.
You have to recognize that Mr. Market is not always rational.
Right.
His prices don't always reflect a company's true worth. You have the power to say no to his offers,
Yeah.
especially when they're driven by pure emotion.
That's empowering.
Right.
It means we're not just at the mercy of the market's whims.
Exactly.
But Graham takes it a step further. He says we can actually use Mr. Market's mood swings to our advantage.
Absolutely. So when Mr. Market is in a pessimistic slump offering to sell you valuable stocks at bargain prices, that's your opportunity to buy.
Okay.
And then when he's overly optimistic, driving prices through the roof, you might consider selling.
Okay.
So it's about staying level-headed
Yeah.
and recognizing when the market is presenting you with a good deal.
That's a powerful mindset shift.
Yeah,
Not letting the market's emotions control you, but instead learning to capitalize on them.
exactly.
So let's talk about a concept that's really central to Graham's approach,
Okay.
margin of safety.
Yes.
What exactly is it, and why does he place so much emphasis on it?
So think of margin of safety as your financial cushion.
Okay.
It's the difference between the price you pay for a stock and its intrinsic value,
Okay.
or what the company is truly worth.
Mm-hmm.
It protects you if your valuation turns out to be off, or if the market takes an unexpected dive.
So it's like having a buffer zone,
Exactly.
okay, to absorb potential shocks.
Let's say you buy a stock for $50, but you estimate its intrinsic value to be $70.
Okay.
That $20 difference, that's your margin of safety.
Got it.
It means you've got some room for error in your calculations or for unforeseen events that might impact the company's performance.
So the bigger the margin of safety, the lower your risk.
Yeah, exactly.
That makes sense.
Mm.
Now, diversification is another big theme that comes up early in the book.
Yes.
How does that play into being an intelligent investor?
So imagine you're putting together a basket of apples.
Okay.
You wouldn't want them all to be the same kind, right?
Right.
What if that variety turned out to be prone to bruising?
Yeah, that's a good point.
The same logic applies to investing.
Okay.
Diversifying your portfolio, spreading your investments across different industries, asset classes, maybe even geographic regions, helps reduce your overall risk.
So you're not putting all your eggs in one basket.
Exactly.
If one investment takes a hit,
Yeah.
Others might be doing well
Right.
to help balance things out.
Yeah. It's about creating a more resilient portfolio that can weather market storms.
That makes sense.
Right.
So Graham goes on to talk about these core security types:
Mm-hmm.
bonds, preferred stocks, and common stocks.
Yes.
And even though the investment landscape has evolved a lot since 1949,
Right.
understanding these fundamentals is still crucial, right?
Absolutely. They're like the building blocks of any portfolio.
Okay, let's start with bonds.
Okay.
What are the key things our listeners should know about them?
So with bonds, you're essentially lending money to a company or government.
Right.
In return, they promise to pay you a fixed interest rate over a set period of time.
Okay.
It's considered a more conservative investment than stocks, offering a steadier stream of income.
So if you're looking for predictability and consistent payouts, bonds might be a good fit.
Exactly.
What about preferred stocks? How do those work?
So preferred stocks are a bit of a hybrid.
Okay.
They represent ownership in a company like common stock, but they typically pay a fixed dividend similar to bonds. They offer a bit more potential for growth than bonds, but they also come with a bit more risk.
Okay, and then there's common stocks,
Right.
which is probably what most people think of when they hear the word stocks.
Right. Common stocks represent ownership in a company.
Mm-hmm.
Their value can fluctuate significantly depending on the company's performance and overall market conditions.
Right.
But they also offer the potential for higher returns over the long term,
Okay.
especially if you invest in companies that are growing and profitable.
So understanding the different characteristics and risk profiles of these security types is a crucial first step
Yes.
in building a portfolio that aligns with your individual goals and risk tolerance.
Absolutely.
Now, Graham spends a good chunk of the book talking about market fluctuations.
Yeah.
What's his main message there?
He wants investors to understand that market ups and downs are inevitable.
Okay.
They're part of the game.
Mhm.
Trying to predict these swings is a fool's errand
Right.
and often leads to emotional decision-making, which can be detrimental to your portfolio.
It's about staying calm and focused amidst the chaos,
Right, exactly.
not letting fear or greed dictate your moves.
And he emphasizes that instead of fearing market downturns, intelligent investors should view them as opportunities.
Okay.
When prices drop, it's like a sale at your favorite store.
Yeah.
You can buy quality assets at a discount.
That's a great analogy.
Right.
So instead of panicking when the market dips, we should be thinking, okay, Mr. Market's having a bad day, time to see what bargains he's offering.
Precisely. And this ties back into the idea of margin of safety. When you buy stocks at a discount to their intrinsic value, you're creating that cushion to protect yourself from losses, even if the market takes an unexpected turn.
Okay, so we've covered a lot of ground already, the different types of investors.
Yeah.
The concept of Mr. Market, the importance of margin of safety and diversification,
Yes.
and the basics of different security types. What's next on our deep dive into the intelligent investor?
Well, Graham then goes deeper into specific investment approaches.
Okay.
He covers things like growth stocks, which were all the rage when he was writing the book.
Right.
And he also delves into more complex areas like convertible issues and warrants.
All right, and of course, he really gets into the nitty-gritty of financial statement analysis,
Yes.
how to actually evaluate a company's financial health and determine its intrinsic value.
Exactly. He provides a framework and specific metrics to help investors make informed decisions, rather than just relying on gut feelings or market hype.
Right.
He truly empowers the individual investor to take control of their financial future.
Awesome. Well, stay tuned for part 2 of our deep dive into the intelligent investor, where we'll explore those investment approaches and delve into the fascinating world of financial statements.
It's going to be good.
It's going to be fun.
All right.
All right. See you then. So we've been talking about how Graham lays the groundwork, for understanding the market and different types of investments. Now, in this next section of the book, he really starts digging into different investment approaches.
Right.
One that he talks about, which was super popular back in his day, is growth stock investing.
Yeah, and what's interesting is that growth stocks are having another moment right now. They are. But Graham, even back then, offered some cautionary advice about getting caught up in the hype.
Right.
He emphasizes that you can't just chase growth for the sake of growth.
Yeah.
You have to carefully evaluate the price you're paying relative to the company's actual earnings and assets.
You know, it's funny how some things never change.
I know, it's true.
We still see this tendency to get swept up in the excitement of the next big thing without really doing our due diligence.
Yeah.
It's like we forget about those fundamental principles that Graham lays out.
Absolutely. And that's why this book is so valuable.
Yeah.
It's a timeless reminder of those core principles.
Mm-hmm.
Now, another area that Graham explores, which might seem a bit more complex, is convertible issues and warrants.
Yeah.
These were quite popular in his time and seem to be making a comeback these days.
To be honest, that's one section where I had to reread a few times to really grasp what he was talking about.
Oh, yeah.
Could you break that down for our listeners who might not be familiar with those terms?
Sure. So think of convertible issues and warrants as a way to potentially benefit from a company's growth.
Okay.
While having a little bit of a safety net.
Okay.
They're essentially options.
Okay.
To convert bonds or preferred stock into common stock.
Okay.
At a predetermined price.
So it's like having a foot in both worlds.
Yeah.
The relative stability of bonds or preferred stock, but with the possibility of converting to common stock if the company really takes off.
Exactly.
Now, for our listeners who really want to get into the nitty-gritty of analyzing companies,
yes,
chapters 11 through 19 are pure gold.
It's the good stuff.
Graham takes you deep into the world of financial statements.
Right.
Balance sheets,
Yeah.
income statements,
Yeah.
cash flow statements, and teaches you how to decipher them.
It's like he's giving you the tools to be your own financial detective.
It is.
He provides a framework for assessing a company's financial health, its profitability, how it manages its cash, and even walks you through specific ratios and metrics to look for.
Wow.
This knowledge is essential for any intelligent investor, even in today's market.
You know, I think a lot of people get intimidated by financial statements.
Yeah, for sure.
They see all those numbers and just want to run the other way.
Right.
But Graham's approach is so clear and methodical, he really demystifies it.
He does, and what I appreciate is that he doesn't just tell you what to look for.
Right.
He explains why it's important.
Yeah.
It's not about memorizing formulas.
Right.
It's about understanding what those numbers actually tell you about a company's underlying business.
That's so key. It's about developing that deeper understanding.
Right.
So you can make truly informed investment decisions.
Exactly.
Now, in the later chapters, Graham tackles some more advanced topics. Like stock options, convertible securities, and even shareholder activism. What are some of the highlights from those sections?
Well, I found his discussion of shareholder rights particularly interesting.
Okay.
Especially his perspective on how investors can actively engage with the companies they own.
Right.
He was really ahead of his time in that regard.
It's not just about buying and holding right.
Right.
It's about being an informed and engaged owner.
Yeah.
And understanding your rights and even advocating for changes if you believe it's in the best interest of the company and its shareholders.
Absolutely. Now, you might be thinking, this is all great, but I'm not a financial expert.
Yeah.
And that's okay. Graham clearly states that you don't need to be a Wall Street whiz to be a successful investor.
That's such a reassuring message for so many people who might feel intimidated by the world of investing.
I know.
It can be scary.
He lays out clear guidelines and principles that anyone can follow, regardless of their financial background.
Yeah.
And remember, he wrote this book for the individual investor.
Right. For someone like you listening right now, who wants to manage their money wisely?
So if we were to distill some of those key takeaways for our listeners,
Okay.
what would you say are the most important principles that come out of The Intelligent Investor?
Well, first and foremost, I'd say it's the crucial distinction between investment and speculation.
Okay.
Graham defines investment as an operation which, upon thorough analysis, promises safety of principal and an adequate return. Anything that doesn't meet those criteria is speculation.
Right.
And intelligent investors should steer clear of it.
So it's about focusing on building wealth steadily and responsibly over time,
It can
not chasing get-rich-quick schemes or risky bets.
Right. And that leads us to another core principle, patience.
Okay.
Graham constantly reminds readers that the market is cyclical. There will be ups and downs along the way.
Yeah.
But if you have a sound investment strategy and you stick with it,
Right.
you'll be able to weather those fluctuations and ultimately achieve your financial goals.
Yeah.
I think that's so hard for people, especially in today's world where everything moves so fast.
I know.
We're constantly bombarded with information and news, and it's easy to get caught up in the short-term noise
Right.
and lose sight of the long game.
It's true, but that's where having those core principles to guide you becomes so crucial. It's like having an anchor that keeps you grounded amidst the market storms.
That's a good analogy.
Now, another key takeaway is the importance of controlling your emotions.
Yes.
Graham stresses that fear and greed are the investor's worst enemies.
Oh, I can definitely relate to that.
I think we all can.
I remember when I first started investing, I would get so anxious when the market dipped.
Yeah.
I'd be tempted to sell everything and cut my losses.
It's a natural reaction, but it's often the wrong move.
Yeah.
Graham's advice is to stick to your investment plan.
Okay.
Even when things get volatile,
Right.
remember, the market will always have its ups and downs. But if you have a sound strategy and you stay the course, you're much more likely to achieve your long-term goals.
So it's about taking a more rational, disciplined approach.
Exactly.
Not letting your emotions dictate your investment decisions.
Right.
That makes a lot of sense.
Right.
Now, Graham also provides some practical advice on portfolio construction,
Yes.
specifically suggesting a specific allocation between stocks and bonds.
Yes, he recommends a portfolio mix of 25% to 75% in stocks,
Okay.
with the remainder in bonds.
Okay.
The exact proportion will vary depending on your individual risk tolerance and investment goals.
Right.
But the idea is to find a balance that allows you to participate in the growth potential of the stock market while also having a portion of your portfolio in more conservative investments like bonds.
And he even suggests rebalancing your portfolio periodically
Yeah.
to maintain that desired allocation, right?
Exactly.
So if your stocks have performed really well and now make up a larger percentage of your portfolio, you might sell some and buy more bonds to bring it back into balance.
Right. This helps ensure that you're not taking on more risk than you're comfortable with.
Yeah.
It's all about finding that sweet spot between risk and return.
That makes sense. Now, another area that Graham emphasizes throughout the book is the importance of carefully selecting your investments.
Yes.
It's not just about buying any stock.
Right.
It's about finding undervalued companies with solid fundamentals.
Exactly. That's where all that financial analysis we were talking about earlier comes into play.
It does.
You have to do your research, understand the company's business, analyze its financial statements, and determine whether it's trading at a discount to its intrinsic value.
So it's kind of like finding those hidden gems that the market has overlooked or undervalued.
Exactly. And that's where all those tools and techniques that Graham provides come in.
Yeah.
He teaches investors how to analyze a company's financial statements, assess its management team, and evaluate its competitive position in the market to determine its intrinsic value.
It's like becoming a financial detective, piecing together all the clues to uncover a company's true worth.
Precisely. And once you've estimated a company's intrinsic value, you can compare it to its current market price.
Okay.
If the market price is significantly lower than your estimated value, that's where you have a potential opportunity for a value investment.
And that's where the margin of safety comes in again, right?
Yeah.
You want to make sure you're buying at a price that offers a cushion.
Right.
In case your valuation is off, or if unforeseen events impact the company.
Absolutely. The margin of safety is your protection against the unknown.
Okay.
It's like having a safety net under a trapeze artist.
That's a great analogy.
So to sum it all up, Graham's approach is about being a disciplined, patient, and analytical investor.
Yeah.
It's about understanding the market, doing your research, and focusing on finding undervalued companies with strong fundamentals. It's not about getting rich quick. It's about building wealth steadily and responsibly over time.
I couldn't have said it better myself. The intelligent investor provides a framework.
It does.
For navigating the complexities of the market and making sound investment decisions. That can lead to long-term financial success.
It's truly a timeless classic.
It is. Well, we've covered a lot of ground in this deep dive.
We have.
But hopefully our listeners have gained a better understanding of Graham's key principles and how they can apply them to their own investment journeys.
Remember, investing doesn't have to be intimidating.
Right.
With a little knowledge, patience, and discipline, anyone can become an intelligent investor.
So instead of trying to predict the unpredictable, what does Graham suggest?
Well, he advocates for a more disciplined approach, like dollar cost averaging.
Okay.
And that's where you invest a fixed amount of money at regular intervals, regardless of what the market is doing.
So basically, you're tuning out the noise and just consistently investing over time.
Exactly. This helps you average out your purchase price over time, reducing the risk of buying high and selling low.
Right.
Which is something that so many investors get caught up in.
That makes a lot of sense. It takes the emotion out of it.
Yeah.
It makes investing more of a systematic process. What other pitfalls does Graham highlight?
Another big one is letting emotions cloud your judgment.
Oh, yeah.
We touched on this earlier, but Graham really drives home the point that fear and greed
Right.
can lead to disastrous investment decisions.
It's so easy to get swept up in the hype, especially when you see others making money quickly.
Right.
I remember when I first started investing, I felt like I was always chasing the next hot stock.
Yeah.
And it rarely ended well.
It's a common experience, but Graham reminds us that the market is driven by these very emotions, fear and greed.
Right.
And if you allow yourself to be swayed by them, you're likely to make impulsive decisions that you'll later regret.
So how do we counteract that? How do we become more disciplined and less reactive to those emotional swings?
Well, it goes back to having a solid investment plan and sticking to it.
Okay. Define your goals. Understand your risk tolerance and develop a strategy that aligns with those factors.
Right.
Then when the market inevitably gets turbulent, you can refer back to your plan.
Yeah.
And remind yourself why you're invested in the first place.
It's like having that roadmap we talked about earlier.
Exactly.
When you feel lost or uncertain, you can consult your map and get back on track.
Right.
Now, there's a section in the book where Graham talks about new issues, or what we now call IPOs, initial public offerings. I found his perspective on those quite interesting.
He was definitely wary of new issues.
Okay.
He felt they often came with a lot of hype and speculation.
Yeah.
And he cautioned investors against getting caught up in the frenzy.
It's like everyone's trying to get in on the ground floor of the next big thing.
Right.
But they often end up paying inflated prices for companies that haven't yet proven themselves.
Exactly. He advised investors to wait until a company had established a track record before considering investing in it.
It's about letting the dust settle and seeing how the company performs in the real world, not just on paper.
That's a great point. It's so tempting to chase those early gains.
I know.
But patience and due diligence are really key.
Absolutely.
Now, throughout the book, Graham emphasizes this concept of value investing.
Yes.
Can you explain what that means and why it's so central to his philosophy?
Sure. So value investing at its core is about buying stocks that are trading for less than their intrinsic value.
Okay.
What the company is truly worth based on its assets, earnings, and future prospects.
Right.
Graham believed that the market often misprices securities, creating opportunities for astute investors to buy low and sell high.
So it's kind of like finding those hidden gems that the market has overlooked or undervalued.
Exactly, and that's where all those tools and techniques that Graham provides come in.
Yeah.
He teaches investors how to analyze a company's financial statements, assess its management team, and evaluate its competitive position in the market to determine its intrinsic value.
It's like becoming a financial detective, piecing together all the clues to uncover a company's true worth.
Precisely. And once you've estimated a company's intrinsic value, you can compare it to its current market price.
Okay.
If the market price is significantly lower than your estimated value, that's where you have a potential opportunity for a value investment.
And that's where the margin of safety comes in again, right?
Yes.
You want to make sure you're buying at a price that offers a cushion.
Right.
In case your valuation is off, or if unforeseen events impact the company.
Absolutely. The margin of safety is your protection against the unknown.
Okay.
It's like having a safety net under a trapeze artist.
That's a great analogy.
Yeah.
So to sum it all up, Graham's approach is about being a disciplined, patient, and analytical investor.
Yeah.
It's about understanding the market, doing your research, and focusing on finding undervalued companies with strong fundamentals. It's not about getting rich quick. It's about building wealth steadily and responsibly over time.
I couldn't have said it better myself. The intelligent investor provides a framework for navigating the complexities of the market.
It does.
And making sound investment decisions that can lead to long-term financial success.
It's truly a timeless classic. Well, we've covered a lot of ground in this deep dive into the intelligent investor.
We have.
Hopefully our listeners have a better understanding of how to apply Graham's principles to their own investment journey. Remember, investing doesn't have to be intimidating with a little knowledge, patience, and discipline. Anyone can become an intelligent investor.
That's right.
All right, that's it for today. Thanks for joining us.
Thanks for having me.